In the past 20 years, gold has actually outperformed the S&P 500. If you look at the chart, you will see the gold curve sitting above the S&P 500, showing that overall gold has delivered stronger returns over the long run. The gold prices tend to rise sharply, then stays flat for months or years before the next big move. And in the most recent 5 years, gold has once again pulled ahead, outperforming the S&P 500 about 20% due to the latest bull run. In this video, I'm breaking things down into 3 parts. Firstly, we'll look at what driving gold strong growth this year. What are the real catalysts behind the rally? Next, we will explore how gold performed during a correction or an economic crisis. Is it the safe haven everyone claims it to be? And finally, let's look at how Warren Buffett and Ray Dalio view gold. Both of them have very different opinions about gold investing, and their view offer good guidance for normal investor like us. I also offer my opinion on gold and compare S&P 500's performance with gold's performance, so please watch until the end of the video. The gold price has outperformed S&P 500 this year, achieving a 50% gain. However, S&P 500 only has 14% gain year to date. From January to April 2025, gold prices climbed steadily as investors look for safety amid inflation fear and a weaker US dollar. But from April to August, prices stay flat. Then starting in September, gold price took off again, driven by renewed expectation of US rate cut. There's 3 kinds of scenario that gold price performs very well. Firstly, gold is one of the best performing assets during inflationary periods. Investors today are increasingly cautious about the erosion of currency value. Every dollar held is worth less over time. That's why many turn to gold as a hedge to preserve their wealth when inflation eats away our purchasing power. Secondly, gold price is driven by demand, and one of the strongest source of demand right now comes from the central bank, especially from China, India, and Russia. They've been buying a large amount of gold to diversify away from dependence on the US dollar and US treasuries, signaling a global shift toward hard assets. Gold and the US dollar are almost inversely correlated, means they typically move in opposite directions. When the Federal Reserve cuts interest rate or signals that monetary policy is shifting into an easing cycle, the US dollar tends to weaken and falls quickly. This makes holding US dollars less attractive. And as liquidity increases, more money flows into assets like gold. In other words, a weaker dollar often fuels stronger gold prices. When the Fed signals rate cut or upcoming quantitative easing, those are usually the strongest catalysts for gold rally. As I mentioned in our previous video, we have already entered a rate cut cycle, and the market is expecting more rate cuts ahead, which continues to support gold's bullish momentum. While everyone online is celebrating gold's recent rally, let's take a step back and look at what happens when gold goes through a correction. In this video, we'll dive into 2 major cases: the big gold crash from 2011 to 2016 and how the gold performed during the economic crisis of year 2000 and 2008. For the 2011 to 2016, gold price experienced a 45% correction. After the 2008 financial crisis, the Federal Reserve announced quantitative easing, or what many call money printing. This policy caused the US dollar to weaken sharply, and as a result, gold price surged, climbing steadily for about 2.5 years, gaining nearly 160% in value. But after gold price reached its peak around $1,800 per ounce, the Fed signaled its plan to exit quantitative easing. This move strengthened the US dollar, and gold began to decline, eventually falling about 45% from its high. This entire correction lasted for roughly 4 years. So the lesson learned here is when Federal Reserve announce monetary policy tightening, it usually means higher interest rates and a stronger US dollar. During these periods, gold prices often enter a prolonged correction phase, and this downturn can last for years. When the tech bubble burst in year 2000, the Nasdaq crashed more than 75%, but the gold held surprisingly strong. Back then, gold was trading around $280 to $320 per ounce, and even as the stock market collapsed, it only slipped to about $260, a roughly 20% drop at most. Then, as the Federal Reserve started slashing interest rate to rescue the economy, investors began shifting into safer assets. By year 2003, the gold already climbed past $400 per ounce, marking the start of powerful multi-year bull run. For the year 2008 financial crisis, when the financial system froze, everyone rushed to raise cash, even the gold got sold off. It dropped from about $1,000 to $700, roughly a 30% correction. But once Fed unleashed massive stimulus and cutting rates, the gold bounced back. By year 2011, gold hit an all-time high of over $1,800, a 160% surge from the low. So the lesson learned is, when economic crisis, gold can fall temporarily during panic selling, but as soon as the interest rate cuts or money printing begins, gold usually becomes one of the biggest winners. When it comes to gold, Berkshire Hathaway and especially Warren Buffett has never been a big fan. Buffett often says that gold doesn't produce anything, it just sits there, unlike a business that creates value, earns profit and grows over time. That's why Berkshire typically invests in productive assets, companies that make money, like Apple, Coca-Cola or energy firms. For Ray Dalio, every investor should hold at least 10 to 15% of their portfolio in gold. He believes that the money we use today is that money. It's created through credit and backed by trust in government. Gold, on the other hand, is not just a shiny metal. It's the most fundamental form of money. It's the real cash. It doesn't rely on debt. It can pay for things without creating new debt. Dalio sees gold as a true hedge, a diversifier that protects investors when stocks and bonds fall, or when countries stop trusting each other's credit. That's why in his strategy, gold acts as an overlay, helping to balance and stabilize a portfolio during uncertain times. So my view on gold is, firstly, I don't own any gold related asset in my portfolio, but honestly I do believe that in the long run, gold prices are heading upward. If you are worried about inflation, gold has historically done a good job preserving value. It tends to appreciate against almost every currency in the world. That said, the recent rally in gold has been pretty steep. It might be wiser to wait for a correction before jumping in and buying your dream gold. Remember, gold doesn't move in a straight line. It can stay flat for a few years before the next big bull run kicks in. So make sure you have got enough liquidity to hold through the quiet periods. That's all for today. Thanks for watching. See you next time.